What's up, everybody? This is Sumko, the Korean Bro. Today is 2024, April 5th. And let's see, today's article. Okay. What article do we have tonight? Hmm. Hmm. Olema Pharmaceuticals and Minerals Therapeutics. First we have here. Sweet Green stock has doubled in only a month, but this other under the radar restaurant is a much better buy today. Sweet Green stock recently skyrocketed after showing improvement in its restaurant level profitability. Investors are optimistic that its improvements can continue, but the company is still reporting steep net losses. Portillo's has an enormous salad business of its own, but the stock is much cheaper. Its long-term potential could even be higher. Or investors have for a wrong seller stock. In the first quarter of 2024, restaurant company Sweet Green was among the stock market's top performers. As of this Friday, shares of the seller-centric chain are up 115% year to date and have doubled in only the past month. It's nice reprieve for shareholders considering Sweet Green stock has largely trended downward since it went public in 2021. Sweet Green stock started skyrocketing for fundamental reasons, which is good. On February 29, the company reported financial results for the fourth quarter of 2023. Quarter four revenue was up 29% from the prior year period, but its restaurant level profit margin surged from 11% last year to 16% in quarter four, which is a massive improvement. Therefore, Sweet Green's financials are improving already, which is why the stock is up sharply in recent weeks. And management hopes to continue financial improvements as it further develops its margin enhancing robotic kitchens. Oh, yes, yet if there is one area that I can criticize Sweet Green, its profitability. The company has promising economics, but still had a full year net loss of $113 million. In other words, it still has a long way to go to live up to its potential. For investors who like the idea of investing in salad, there's another publicly traded company that has a strong salad game, but fortunately, it does more than salad, and the business is growing and delivering profits for shareholders today. Is Kava Group stock still a hot buy after rallying 16% this year? Kava has been aggressively growing its business. It plans to open around 50 new locations this year. Its profit margins, however, are slim, and organic sales growth has been slowing down. Their stock trade at a premium compared to many other restaurant stocks. Is it worth it? A top restaurant stock to own this year has been Kava Group, up an impressive 60% thus far. Investors have been bullish about the Mediterranean fast casual restaurant brand, its ability to cater to a broad and diverse customer base, which could make the chain more resilient amid a challenging economy. While the company has been achieving some strong results in recent quarters, has the stock become too hot to buy right now, or could shares of Kava still soar higher? The company is coming off a strong 2023. In February, Kava reported its fourth quarter and year-end results. For the quarter ending December 31st, 2023, the company's revenue totaled $177.2 million and grew by 36% year over year. The company has not only been opening more locations, but its existing stores have also been producing strong numbers. Comparable restaurant sales were up by more than 11% in the fourth quarter. That's a great sign that demand remains strong and growing. For the full year, Kava's Com's growth was even higher at just under 18%. Impressive results have helped the company attract many growth investors. During the full year, the company opened 72 new restaurants, and in 2024 expects to open between 48 and 52 new locations. So Kava's business did well last year, but the modest Com's growth it is expecting this year is what would prevent me from buying stock right now. Its growth store appears to depend too heavily on new store locations. New store openings. And while that's a good way to manufacture growth, it's organic growth that investors should focus on, and the number is slowing down. At such a high premium to earnings and revenue, Kava just isn't doing enough to show that it is worth its nearly $4 billion valuation. Until the company can show investors it can post strong profits, not depend on new store openings to generate a high growth rate. This is that I would avoid for the time being. Snowflake. Okay, Snowflake, a once in a generation investment opportunity, one growth stock to buy now. The demand environment for Snowflake data cloud services has started stabilizing. Snowflake Marketplace, Snowpocket, and Snowflake Cortex are major competitive advantages. Valuation has become reasonable compared to historical levels. So Snowflake can prove to be a long-term winner despite several near-term revenue headwinds. Cloud-native data storage and analysis specialist Snowflake's shares tanked 33% since the company released its fourth quarter fiscal 2024 earnings report on February 28. While the company's fourth quarter revenue and earnings surpassed consensus estimate, investors are disappointed with underwhelming guidance for fiscal 2025. Snowflake expects technology advancements and produce product efficiency gains to make the platform even more cost effective for customers. This implies less spending by customers, which in turn will affect the company's fiscal 2025 revenue. Plus, the rollout of tier storage pricing is also expected to negatively affect future revenue. Snowflake's further gearing up to make its portfolio open source iceberg table format generally available around June 2024. Subsequently, some large customers expect to shift out a portion of their data from Snowflake's platform to iceberg tables. Besides long-term hmm, Toast. Toast platform is built from the ground up to meet the unique needs of restaurant operators. The growing complexities of this industry increasingly require tools like the ones Toast offers. This high potential style also brings high risk volatility to the table for investors. Toast's top line is on a growth streak, giving investors good reason to get excited again. They say necessity is the mother of invention. That's not always the case. But the point is well taken. Take Toast as an example. Restaurants don't absolutely needed software to manage their complicated businesses. However, the tools it provides can certainly help them, and we are recognizing this fact. That's why Toast top line is expected to continue its growth streak this year with a 25% improvement. So if the company software is so great, then why is the stock down 65% from its 2021 peak? For a reason veteran investors have seen before. In fact, this reason is also why many of these veteran investors are eyeing this weakness as a buying opportunity. Toast is facing temporary headwind. Up close and personal. Managing a restaurant can be a major headache because there are so many moving parts: kitchens, people, supplies, food, payment processing, inspections, payroll, advertising, etc. It's a lot. Toast makes it easier to get a handle on all of the details. Mm. So, although it's often categorized as a point of sale solution, Toast is so much more. It helps restaurant managers take food orders, process payments, schedule and pay workers, cultivate a customer list, make kitchens more efficient, and even handle online orders, all from a single integrated platform. More than 100,000 restaurants now rely on Toast turnkey system. But the question remains, why is it stuck down so much? So Toast has been around since 2011, but as you can imagine, the COVID-19 pandemic helped put it on the map. Restaurants were forced to meet a swallow demand from the consumers who are suddenly ordering food online and looking for contactless ways to retrieve and pay for it. And result, Its top line soared from $823 million in 2020 to $1.7 billion in 2021. Its sales have held doubled again since then. Like many other companies, Toast used the unique circumstances of the pandemic to raise funds. When published in September 2021, its newly issued shares experienced a few bullish nibbles shortly thereafter. By the time 2021 was turning into 2022, though, the health crisis faced was winding down. People were getting out again and losing interest. They were particularly losing interest in stocks were priced richly like Toast shares were. In retrospect, its by pullback isn't all that surprising. Sellers, however, have arguably overshot their target. Let's read this one. Meanwhile, Amazon has three important growth engines in e-commerce, digital advertising, and cloud computing. E-commerce, digital advertising, e-commerce, digital advertising, and cloud computing. And the company is working from a position of strength in all three markets. To elaborate, Amazon runs the most visited online marketplace in the world, which has naturally made it the largest retail advertiser in the world. Meanwhile, Amazon Web Services is a leader in cloud infrastructure and platform services, as well as several subcategories, including artificial intelligence developer services. Amazon is leaning into AI to improve its standing in all three markets. It recently launched a generative AI shopping assistant called Rufus. It uses machine learning to optimize inventory and delivery routes for its logistics business. Amazon also introduced a generative AI tool that creates marketing content for advertisers. And the company continuously tweaks its machine learning models to make product recommendations more relevant. Finally, AWS has made its cloud platforms more compelling with two new products: Bedrock, a service for customizing large language models and building generative AI applications. Amazon Q is a generative AI business system that cores and custom summarizes data from various internet action sources. CEO Andy Jassy believes generative AI alone will create tens of billions of dollars of revenue for Amazon over the next several years. Amazon reported strong financial results in the fourth quarter, beating expectations in top and bottom lines. Revenue increased 14% to $170 billion. Operating margin expanded 47th consecutive quarter. And then GAAP net income improved to $1 per diluted share, up from $0.03 per diluted share in the prior year. Going forward, Amazon has a good shot at double-digit sales growth through the end of the decade. I say that because retail e-commerce sales are forecasted to increase at 8% annually. The digital advertising market is expected to expand at 15% annually, and the cloud computing market is projected to grow at 14% annually through 2030. Cloud computing market is projected to grow at 14% annually through 2030. The digital advertising market is expected to expand at 15% annually. Wall Street analysts have similar expectations. The consensus calls for Amazon to grow sales at 11% annually over the next 5 years. That makes its current valuation of 3.3 times sales appears reasonable. Investors should consider buying a small position in the stock today, especially as part of a larger basket of AI stocks. Realty income block. Shares of Confluent have jumped more than 26% so far in 2024. Okay, anyway, this is it. I'm a bit tired tonight, and this is it, and I'm gonna see you tomorrow. Okay. Okay, see ya and have a good night. Okay, bye bye. Tonight, I'm a bit tired. Okay, give me a break. Okay.